Hi, I'm Bob Keiser, Vice President with Global Markets Intelligence at S&P Capital IQ. Thanks for previewing this week's edition of the Lookout Report. The past few weeks have seen a dramatic increase in equity market volatility that has pushed the Chicago Board Option Exchange Volatility Index to the highest level seen in over 2 years. The spike in volatility and the commensurate 8% decline in the S&P 500 stock index is broadly being linked to slowing economic growth in Europe and investor anxiety caused by the emergence of Ebola infections occurring within the continental United States. At a higher overview level, S&P Capital IQ Global Markets Intelligence Research relates the recent uptick in market volatility to a significant increase in the degree of perceived uncertainty that investors have abruptly been forced to acknowledge. As perceived uncertainty rises, it is perfectly understandable that volatility should rise as well. We see increased uncertainty and volatility as being grounded in the following observations. First, the rapid deceleration of European economic activity that was largely unanticipated by investors at the start of the year, or even as recently as mid-year 2014, which is at least partially a byproduct of the geopolitical Russia-Ukraine conflict. Then there is the rapid strengthening of the US dollar and the unknown consequences for the US economy due to marginally tighter financial conditions arising from dollar appreciation combined with the conclusion of the Fed's quantitative easing policy. The prospect of slowing global economic growth could also have investors rethinking what continue to be very optimistic 12-month forward S&P 500 corporate earnings expectations, since nearly half of S&P 500 corporate revenue is estimated to come from non-US sources. Over the past few years, investors have also become quite accustomed to highly subdued market volatility, which likely induced a good deal of complacency when it comes to risks such as short-term capital losses, which are traditionally associated with the stock market. Having said all this, GMI Research remains bullish on the U.S. economy and the outlook for the equity market in the coming year. The U.S. economy continues to show signs of improvement. U.S. corporations are currently experiencing a revival of top-line revenue growth, providing a foundation for what are expected to be double-digit S&P 500 earnings growth in 2015, according to the S&P Capital IQ consensus. For further thoughts on this topic, plus additional cross-asset class insights from McGraw-Hill financial thought leaders, see this week's Lookout Report titled Equity Market Volatility Reemerges. Until next time, I'm Bob Keiser with S&P Capital IQ.